Fed met. It was a 2-day meeting, Tuesday and Wednesday. They're on a funny schedule. They meet 8 times a year. Like it's not monthly. It's not twice a year. It's not quarterly. It's 8 times a year. So kind of a wacky schedule, but that's the Fed. But this was their meeting. Technically, the FOMC, Federal Open Market Committee, which sets interest rates. But just to be clear, when I say they set interest rates, they set one interest rate. It's the Fed funds, so-called Fed funds target rate. And what are Fed funds? Fed funds it's overnight money that banks lend to each other. So you're supposed to have a certain reserve position. If you're getting short at the end of the day, you call up another bank and you borrow some money from them, and then you meet your requirement. It's been going on for a long time, but it's an overnight money market between big banks. That's what Fed funds actually are. And the Federal Reserve can target that rate and kind of get in and out of the market as needed to keep that rate where they want. But that's an overnight rate. It's not the rate to your treasury notes, 5-year treasury notes, 10-year treasury notes, 30-year bonds. In other words, the Fed does not set rates for the whole market. They think they do. They think if you set a short-term rate, that a longer-term rate is just sort of your best expectation of a strip of short-term rates. And so by playing with the short-term rate, they can influence the longer-term rates. That's not really true. Those markets have their own, I'm not saying they don't pay attention, they do, but they have their own dynamics. But it's just one of many things that the Fed gets wrong. But I always say, if you want to forecast the Fed, which we do, you have to think like the Fed. And that means thinking a lot of things that are technically wrong, but you got to think them anyway because you're trying to outguess people who are thinking the wrong things. But anyway, that's their target rate. Just as another footnote, there hasn't been a Fed funds market since 2008. So the Fed is setting a target rate for a market that doesn't exist. That's just to show you how ridiculous this is. I mean, when you really peel back the layers of the onion, there's not a lot of there. But, Jay Powell stands up. They have an announcement at 2:00. He does a press conference for an hour from 2:30 to 3:30 Eastern time. And all the newspapers write about it. I follow it. We follow it. We publish newsletters on it. So we're very much on top of it. But I do have difficulty thinking about the fact that it doesn't really matter very much, despite all the publicity it gets. So what they did is they left this target rate. But just be clear on why there's no Fed funds market. Banks don't need reserves. They've got over $5 trillion of excess reserves on deposit with the Fed. So the notion, I said, well, gee, banks short reserves, they got to go out and borrow them, and that's a market. And that was true for a very long time until 2008. It's not true today. They have trillions of dollars of excess reserves, so they don't even have to do that. Instead, the Fed pays them interest on the reserves. And that's kind of the rate that they're targeting. But I don't want to get too in the weeds on this. Maybe I already have, but think of it as just a short-term overnight rate. But it's actually kind of a Fed. It's not the Fed funds market. It's an overnight repo rate from the Fed. But anyway, that's what they said. So what they did, they left it unchanged. So they from March 2022 to July 2023. They raised rates from 0 to 5.5%. That's a very steep, very fast rate increase. You have to go back to the Paul Volcker days in the early 80s to find something comparable. But then they paused. So from July 2023 to September 2024, they did nothing. They just kept rates unchanged at that level, trying to see if that would work. And then inflation did come down over that period. It was 9.1%. Inflation was 9.1% in July 2022. And by last August, it was down around 2.3%. I don't have the exact number in front of me, but it's 2.3, 2.4. So it was a big accomplishment. So the Fed's kind of patting themselves on the back. And they said, okay, now we feel comfortable lowering rates. So last September 2024, they cut rates by 50 basis points. That's a lot. They usually move in 25 basis points. It's 1/4% increments up or down, depending on what they're doing. But they took a big jump down, 50 basis points, another 25 basis points in November, and another 25 basis points in December at those meetings. So now you're down 1 full percentage point from 5.5% to 4.5% for the target rate. And then here comes January. So why didn't the Fed keep cutting rates? They started the rate cuts in September. Why didn't they keep doing that? The answer is that they have what's called a dual mandate, meaning they've got two jobs. One is to price stability, so keep inflation under control, yes. But the other one is to keep unemployment low. In other words, create jobs and watch the unemployment rate. So you want stable prices and low unemployment. Those are two good things, but they contradict each other. It's extremely difficult to do both at the same time. The theory was that if rates are low, inflation is going to take off. Or sorry, if unemployment is low, inflation is going to take off. Or if unemployment is high, inflation is going to be low. And so those two things counterbalance each other. If you're keeping inflation under control, unemployment might go up a little bit, but if you keep unemployment low, inflation might go up. So it's kind of a seesaw, and you were trying to get both things just right. The problem is that's not true. Everything I just said, is not true in the real world. The Fed thinks it's true, something called the Phillips curve, but the Phillips curve doesn't exist. I mean, you can draw one, but right now it's a flat line, not much of a curve. So in the real world, the Fed has to choose. They can keep prices stable by raising rates, or they can keep unemployment low by cutting rates. But it's hard to target both of those things. So they have to pick one. And what they do is they pick the one that they're most worried about at the time. So in September, November, December, as I mentioned, they cut interest rates. That's because they were worried about unemployment. Unemployment was going up. It went up from about 3.4, 3.5%. A little over a year ago to 4.2%. I think the most recent number was 4.1%. But that's unemployment. That's still a big jump over the course of the year. And I mentioned inflation came down from 9.1 to about 2.3 or 2.4 about 4 months ago. So the Fed was saying to themselves, okay, we've got inflation. We won the battle against inflation. Inflation's come down. It's still coming down. That's good. Unemployment's going up. So we better worry about unemployment. So let's start cutting rates. And we're not really going to worry too much about inflation. Well, instead, it blew up in their faces. Inflation took off again. From September, October, November, December 2024. We don't have the January numbers yet. They'll be out in about 10 days. But in those 4 months, inflation went up all 4 months. And so instead of going down, which it had been, all of a sudden it's 2.5, 2.6, 2.7. I think the most recent reading was 2.9. I'm talking about headline CPI. That's the rate I use. That's the rate that people actually pay when they go shopping. They have all these other rates, inflation rates. They got like 10 of them. There's CPI core. There's CPI regular, CPI core, CPI super core, where you take out food, housing, and energy. So I always say if you live in a tent and don't drive and don't eat, that's the one for you. But if you're a real person, I look at headline CPI, and that's what we have on the screen right now. Matt put that up, and you can see exactly what I described: the peak in 2022, but now going up again just in the most recent months. And there we go, 2.4, yeah, okay, 2.9, that's what I said for December. So inflation is back, and unemployment, I mentioned, has gone up, but in the most recent month it went down from 4.2 to 4.1. So the Fed all of a sudden switched sides and said they were worried about unemployment, so they were cutting rates. But now all of a sudden they're worried about inflation again. So they're like, unemployment is not too bad. It's going up, but it's not too bad. It's what they call normalizing. I always say you need a decoder ring to understand what the Fed's saying, but they pick these buzzwords. I know the guy who writes these things. They pick them on purpose, but their view of unemployment is it's normalizing, meaning it might be going up, but still not too bad. We can live with it. Inflation was a real concern, as you saw in that chart Matt just showed, where long period of going down, but now it's going up again in recent months. So they decided to pause, meaning they're going to keep rates at what they think is a tight level to fight inflation. And if unemployment goes up a little bit, they're not too worried about it. Here's the truth. The truth is they don't know what they're doing. They don't know what's coming next. And they kind of said that. It's rare for the Fed to say that, but in his last press conference in December, and again a couple of days ago, Jay Powell said, we're looking at data. Well, so am I. We're all looking at data, but I'm not the Fed, but they are. But they don't know any more than we do, maybe less, actually, because I think we get our models right. But so they're just, it's kind of like do nothing is the best. If you don't know what you're doing, do nothing. Sometimes that's good advice. And that's what they did. They did nothing. So the question for investors is, okay, what happens next? What's going to happen to inflation? What's going to happen to unemployment? And what are they going to do at the March meeting? I think it's March 19th. Could be off by a day, but around March 19th is the next Fed meeting. What are they going to do? They very much signaled that they're going to pause again. In other words, it's going to take a big drop in inflation to get them to go back to rate cuts. They're very worried about inflation, and it's going to take a big drop in unemployment to get them to same thing, basically to cut rates at that point. So what's likely to happen is unemployment is going to start to go up. We're at a point where new hiring has completely dried up. The layoffs have not begun in a big way. Unemployment goes up when companies laying off 10,000, 20,000 workers, small businesses are laying off staff, left and right. That wave of unemployment, that wave of basically people getting fired and unemployment going up, hasn't hit yet. But what has hit is new hiring. New hiring just hit a wall. Nobody's hiring anybody. They're not firing people en masse, but they're not hiring people either. Well, that is a strong signal that the wave of unemployment is about to begin. The companies don't like to fire people. They're hard to hire. They're hard to train. You get a team. Everyone's doing their jobs. The last thing you want to do is fire people. You'll do everything else, negotiate the rent down, cut the laundry bill, turn the lights off. You'll do everything you can to save money, except fire people. That's the last thing you do. But we're getting close to that point. So as far as inflation is concerned, I mentioned inflation is going up. It has. It's gone up a lot. The Fed's concerned. That's why they did not cut rates in January. But this is a kind of supply side inflation that tends to snuff itself out. In other words, a lot of it's driven by energy prices. And there's a saying in the markets, the best cure for high energy prices is high energy prices. In other words, when the price of gas at the pump, diesel fuel, jet fuel, all that goes up enough, people react to it. They drive less, the airlines raise prices, and people fly less, and they buy fewer consumer goods, and there are fewer trucks on the road, et cetera. And then that tends to bring it right down. We're in a period of oversupply. Trump's going to be talking to OPEC. We've been cutting off Russian oil exports as much as possible. But Russia's still exporting oil to China and India and elsewhere. They're pumping as much as they can. In the U.S., it's going to be drill, baby, drill. You can already see that coming. Whether the oil companies actually do drill that much remains to be seen. They may get permission to do it because of Trump, but they may not want to do it because of oversupply. So my expectation is that the inflation may go up a little bit more because it lags and energy prices have been going up, but that will start to turn around. Not all at once, but that'll peak around 3% and then maybe start to turn around. And then for unemployment, it has not been going up a lot, but it's going to start to go up a lot. You'll see it kind of 4.3, 4.4, 4.5. At that point, the Fed will flip again, meaning they'll start cutting rates because, hey, it's kind of back to where they were in December. Inflation's under control, unemployment's too high, so we need to cut rates. We're not there yet. We probably won't be there by March. I don't expect the data by March. Even if it turns a little, it won't turn a lot. The Fed doesn't turn on a dime. They need to see 3 or 4 months of data before they're convinced that the turn has taken place and they can change policies.